Are we live?
Yes, we are live.
Okay. Hmm. So I'll start. So good morning, students. Today, what we are discussing is the continuation of where we left yesterday. So yesterday was day one of revision, and if you have attended yesterday's class, yesterday we completed total four chapters, which means almost module one is completed. So we completed the chapter one, first chapter, which was intro to FM. Then we went into second chapter. Second chapter we completed cost of capital. Then we did leverages, and then we did completely capital structure. So module one we have total 6 chapters. What is remaining from module one is working capital management, and second one is types of financing. As already discussed in yesterday's class, types of financing is a completely theory chapter where it would be better only if you read the chapter independently and see previous year questions. So if you see the previous year questions, you will understand a pattern from where questions are asked. In types of financing, it is not important that you have to read completely, completely word by word. It would be enough if you identify the pattern. Once you identify the pattern, you will get to know on the types of financing, mostly financing of loans, or maybe some bridge finance. So only these questions are important. There are some few questions from which ICA usually asks questions. If you read that questions, it is sufficient. Then working capital management, we would be completing it. Working capital management, we would be doing it. Now, what I have noticed is that there are only 3 chapters. There are 3 chapters where doing the problem student faces difficulty. The first chapter is capital budgeting. Capital budgeting is one of the important chapters in the complete financial management. Usually an 8-mark question is expected, or maybe a 2 4-mark questions are expected from capital budgeting. So it is a heavyweight. It is a heavyweight chapter. One is capital budgeting, where student faces difficulty to solve the problem. Second one is working capital management. Now, working capital management looks easy. We know how to calculate all the ratios, but it looks easy. But where student faces struggle is that they don't know how to approach the problem. So when they see the problem, it looks easy. But when we try to do the problem, working capital management is one such chapter where if we stuck in the middle, you won't be able to solve the problem. So you should not be stuck. While solving the problem, you should have an approach in your mind. And only after having an approach in your mind, you should solve problems of working capital management. Then the third chapter where student faces difficulty is ratios. Ratios is again same. Working capital management ratios is again same, where people used to uh, face difficulty in solving problems, not in understanding. Understanding is very easy, but solving problem is where people faces difficulty. So these 3 chapters alone, I would request you solve different questions from different sources. So you can at least solve, the past 3 RTPs, not 3 years RTP, past 3 RTPs, because it happened many times that whatever is coming in May RTP is directly coming to the exam question of November. So you should solve the November RTP, of course, because their new questions will be covered. November RTP, May RTP, and you also cover the last year November RTP. These 3 RTPs, if you cover, for this time perspective, I'm telling, if these 3 RTP you have covered, I think your problem solving ability will be good. And also the mock test of this year. Mock test, usually repeated question comes, but it would be better if you see the mock test questions as well. In these 3 chapters, practicing problems is very important. Knowing the concept is one part, but in these 3 chapters, practicing problems is very important, because lot of silly mistakes are possible. A lot of approach problems are there only in these 3 chapters. So practicing problems in these 3 chapters is what I would request you to do, so that you would be scoring good marks, because usually this 3 chapters covers a good amount of portion. These 3 chapters very easy. The only thing is you should solve problems. Now what is our today's agenda? Today's agenda, the agenda for this session, 10 to 1. See, actually we will be completing this class much earlier. We would not be extending till 5 o'clock as we have our schedule. We will be completing much before time, because we covered a good portion. Module 1 is almost covered, and if we have time, I will take up some doubts, or I will solve some questions based on your request in the end. So in the end, what you can do, you can, if you have any request that this concept you want me to take, or this problem you want me to solve, or somewhere where you have stuck, you can put in the live chat, and I will see the chat and I will address it in the end. So let us now get into the discussion. Let us start with capital budgeting. Capital budgeting, the chapter name is investment decisions. Now, if you see, in investment decisions, it is one of the important chapter. Why? What is the reason? The reason why investment decision is important is because it includes, a huge amount of money. I'm telling why this chapter is important, why you have to learn this chapter. One reason, one reason is because it is a long-term investment decision. Why it is important? Okay, why it is important? It is because it is a long-term investment decision. One reason. Second one, huge cash outlays involved. Okay, huge cash outlays are involved. Correct. See, whenever I already said you in a balance sheet, you have 2 items. One is you will source the funds. So how you will source the funds, you will see in types of financing, what should be the cost, what should be the capital structure, how you should lever the company. All this we discussed in yesterday's class. Now you got the money, what you'll do with the money? You will put it in pocket? No, you will invest somewhere. So this investment is called as investing decisions. Now we have to see where we have to invest, correct? First thing, suppose if my WAC, if my overall cost of capital is 14 percentage, you have equity, you have debt, okay, everything, your weighted average cost of capital, your overall cost of capital is 14 percentage. Now when you have identified this cost, now it would be easy for you to take investment decisions. Now suppose if you're having a project, where the project return is 20 percentage, what you will do, you will invest in that project, and this 4% is what will become your profit. And that profit either you will retain or either you will distribute, and that will be another decision, dividend decision. But now what we are seeing is the investment decision that covers the asset sides of the balance sheet. This covers the asset side of the balance sheet. So conceptually, this is what is investment decision. Why investment decision is important? Because if you're taking some huge amount of money, you invest in long-term projects. Okay, you're not investing in short-term projects, you're investing in long-term projects. So when you're investing in long-term projects, your decision become irreversible. Your decision becomes irreversible. This is a theory thing that I'm discussing. There is one question in textbook, why capital budgeting is important. All these points are there in the question. If you open the study material, module 2, chapter number 7, I think. Yeah, chapter number 7, you will see this question, why capital budgeting is important. First reason is it is a long-term investment decision. Second reason, because huge cash outlays are involved. Third one, because it is irreversible decision. Fourth thing, because it is a risky decision. It is a risky decision. Okay, because huge amount of risk are involved. Once you're taking an investment decision, the cash flows what you're expecting are future cash flows, and future cash flows are uncertain. With uncertainty, there comes a risk. So by mitigating all the risk, by evaluating all the risk, you have to take the decision. So it is a risky decision. Okay, and fifth one, why it is important, the closure. If the decision does not went right, the closure involves huge cost. The closure involves huge cost. Now, just see, I'll just take an example for you to understand. Suppose, okay, you cannot see, investment decisions is just like buying a car. Okay, now if you're buying a car, say you bought a car for 20 lakh rupees. 20 lakh rupees, don't worry, once you become a CA, you can afford that amount. So you're purchasing a car for 20 lakh rupees. Now it is a long-term decision, correct? You cannot take that today I will take a car and okay, after 1 month, if I'm not satisfied, mileage is not correct, or maybe the car is not running smoothly. So you will sell the car. What will happen? Only half the price you will get. Only second-hand market, only half the price you will get. So the closure, if the wrong decision is made, this closure is involving huge cost. 20 lakh rupees, 1 month you're using it, you're not feeling very good. Now, if you want to sell this car again and if you want to purchase the proper correct car, this involves a huge cost, correct? Because 20 lakh car has directly slashed down to 15 lakh or 10 lakh rupees. So a huge cost is involved. Second, it is a long-term investment. Once you're deciding to take a car, you have to see it from a long-term perspective. Because if you're taking a car, definitely you will use it for 5 years, 7 years, 10 years. So you have to see from a long-term investment decision. Now the second one is huge cash outlays are involved. You are not purchasing a toy car. You are purchasing an actual car which involves a huge cash outlays. So huge cash now there is also some opportunity cost. You can also think car வாங்கலாமா இல்ல I can invest or I can invest. So always huge cash outlays are involved. So this decision requires, utmost evaluation and very carefully you should take this decision. Third one, it is irreversible. As I thought, once a car is purchased, it is purchased. Okay, after 1 month, you cannot say, no, no, I don't want this car. Now I want that car. So that will involve huge cost. So it is an irreversible decision. Fourth one, it is a risky decision. Correct. Why risk? Because future you don't know what will happen. What if today you're purchasing and tomorrow you're not liking the car? Okay, you can also put many examples in this, but this is why capital budgeting chapter is important. Now, while taking a capital budgeting decision, you should evaluate the decision, correct? Now, how to evaluate the decision? That is where we have some techniques of capital budgeting. I think I didn't tell you what type of problems are possible. See, first thing you should always, whenever you're starting any chapter, first thing you should always understand what are all the types of problem that I'm going to see. Because from exam perspective we are studying. If I'm studying a theoretical perspective, or if I'm taking a regular class now, I would have gone concept wise completely from start to end. But since it is an exam perspective, you should always understand what types of problems come, what is the probability of coming the problem, and how many concepts are involved in that problem, and how much time it will take to discuss this. Now if we see the types of problems, if we see the types of problems, only two types of problems are possible in capital budgeting chapter. Okay, one will be the techniques. They will ask a question based on the techniques and then to take a decision. the techniques and to take decision. What will happen? They will give you some certain set of cash flows or certain set of problem, and they will ask you, okay, so some technique of capital budgeting they will give you in the question, and you have to evaluate on the basis of the technique which is given. Suppose they will give you the question and then they will give you three subheadings. First one, calculate the payback period. Second one, calculate the accounting rate of return. Third one, calculate the net present value. Like this, if questions are asked, that is what is one type of question, which is they will give you a technique. They will exactly give you what technique you have to use, or based on that technique you should take a decision. Okay, now what are all the techniques of capital budgeting? That is what we are discussing. What are the second type of problem? Now that is where many students struggle. The second type of problem are case study problems. Are case study problems. What will happen? They will give you a proper case study. Under case study also, there are only usually there are two types of case studies. Okay, first one is some fresh investment that you have to make. Second one is some replacing, you're replacing some investment. So suppose you're having a machinery, you're replacing that machinery. Second one is replacement decisions. So case study problems is where students are struggling. Why? One page problem will be given, lot of information will be given. Based on that information, you have to take a decision whether to accept the project or reject the project, or take the project or does not take the project. So that decision you have to make. That is what is a case study problem. Now here you have to identify which method you should use. So usually here NPV method is only used. So NPV or IRR. So usually under second problem, usually NPV method is used. Now, if you see, two types of problems are possible. First, techniques. Both are having 50-50 chances of coming. That is the reason we are discussing both the types of problems. First, we have to take what techniques we should use. Second one, case study problems. And in that case study, I will give you a proper structural approach. Whenever any case study problem comes, you have to write it in an approach which I'm going to discuss. So once you are having that approach in your mind, trust me, no problem will be difficult for you in capital budgeting. Okay, capital budgeting is not a chapter where you should be scared, but it should be a chapter where you should be confident. Why? Because it is a very structural chapter. Once you study it structurally, it will become easy for you. Let us discuss now. Let us discuss. Let us go into the chapter. Okay, let us rush through. Okay, let us not rush. I won't call the word rush. Let us brush through. Okay, so capital budgeting techniques. So actually in the study material, it is bifurcated into two. We have traditional method also. Okay, we have traditional techniques, and then we have modern techniques. So under traditional techniques, usually we have only this two are important. One is this payback period, very important in traditional. Second one is ARR. ARR, it is nothing but accounting rate of return. Right? Now under modern techniques, we have few techniques. Okay, we have few techniques. I'll give you the techniques. The first one is NPV. The second one is IRR. I'm giving in the order of importance. Okay, NPV, and then we have this IRR, and then we have profitability index. Profitability index, And fourth one is nothing but an extended version of this discounted payback. Right? So these are the techniques that we are going to discuss now. These are the techniques that we are going to discuss now. Now, without wasting much time, let's get into directly. Now, if I want to tell about capital budgeting, here profits are not important. Here cash flows are important. In financial management, cash flows are given more importance. In fact, cash flows are supreme than profits. Because I've given many reasons are there. We will not take profits, we will take cash flows, because profit includes all non-cash items, many items are included, so we take cash flows. So whenever you're doing any capital budgeting problems, first thing is you have to estimate the cash flows. Whenever any problem comes, you have to estimate the cash flows. Once all the cash flows are there, from these cash flows you can use those methods. Profit is used in financial and profit is used only here. In this ARR is alone profit is used. Actually, ARR is not even a financial management topic. It is an accounting profit. It is an accounting topic, but they've included here in financial management. Okay. It is forcefully included. Actually, it is not even a financial management thing. So profit is used only in one place, which is ARR. In all other places, cash flows are used. So whenever any capital budgeting problem comes, one thing that should be in your mind is that we have to estimate the cash flows. Okay, we have to estimate the cash flows. So first, let us knock off this profit thing first. Okay, first let us see what is an ARR. Okay, ARR is nothing, the accounting rate of return. It is nothing but profit divided by investment. Okay, you have to put average PAT divided by average investment. This is the only formula for ARR. Now, if you see the textbook, there is one problem where, three types problems are solved. Instead of average investment, they take the total investment. So total method, average method, many methods are there. Once you see the study material, you will get to know. But this is the basic formula. The basic formula is profit divided by investment. So since we are doing in a multi-year period, suppose you are having cash flows for year 1, year 2, and year 3, what you have to do first thing is you have to identify the PAT. How to identify the PAT? You already know that we will have to draw the income statement. Suppose if details are given, sales minus variable cost, you will get contribution. Okay, minus fixed cost, you will get EBIT. Okay, minus interest, you will get earnings before tax. Minus taxes, you will get earnings after tax, profit after taxes. And this profit after taxes you will get for year number 1, year number 2, year number 3. Then you do divide it by 3 to get the average PAT. So this will be the average PAT. Now average investment, the beginning opening year investment and the end year investment. Okay, you just have to do the average and then you will get the average investment. Suppose you have started by investing 10 lakh rupees and at the end of year 3 you're having the salvage value of say 20,000 rupees. So you just have to do 10 lakh plus 20,000 divided by 2. So it is investment at the beginning. Okay, investment at beginning plus investment at end divided by 2. This is what is the formula for average, the accounting rate of return. Very simple. Usually, in the first type of problems, these things are detail will be given and they will ask you to find out the what is the average rate of return. Okay. Now, second one, we will go into, so only in this places profits are used. Now, whatever we are discussing now, cash flows will be used. So before going into, first you should know how to estimate the cash flows. How to estimate the cash flows. Suppose someone is telling you, I am having profit after tax of 100 rupees. So do you have to use the profit? No, you have to identify the cash flows. Now in this profit, non-cash item will be there. One such non-cash item is depreciation. What you have to do? You have to add back depreciation. You have to add back depreciation. Say the depreciation is 120 rupees, then this will be the cash flow. Okay. So 100 rupees we should not consider. 120 rupees is what we have to consider, because under capital budgeting, cash flows are only discounted. Why cash flows are discounted? Profits cannot be discounted. Only cash flows can be discounted. What you're putting in the bank, you're putting profit, or no, you're putting a cash. So that is the reason when you want to discount any number, you only have to discount cash. Okay, you cannot discount non-cash items. So whenever you're doing any problem in capital budgeting, first method, okay, the first step, this is the first step in anything, you have to estimate the cash flows. You have to estimate the cash flows. Okay, now let me tell you one thing. Let me tell you one thing. Any problem you're doing, usually depreciation will be there. So how it will happen is that suppose you're having EBITDA, okay, earnings before interest, depreciation and taxes. Okay, okay, earnings before interest, depreciation and taxes and amortizations. So suppose when you're having EBITDA, what you do, you will reduce depreciation to find out earnings before interest and taxes. Correct? Then what you will do, you will reduce interest to get earnings before taxes. Then you will reduce taxes, you will get earnings after taxes. This is what is PAT. So when you have to calculate the cash flows, what you have to do, you have to add back the depreciation. Plus depreciation, if you add, only then you will get the cash flows. Only then you will get the cash flows. Now many people will ask the question, actually I'm writing it cross 1 minute. Yeah. So many people ask this question, what is this? What is this logic? Here you're reducing depreciation. Here you're adding depreciation. What is this adjustment? Because we are having a tax adjustment here. Whenever we are having depreciation, we will get a benefit, that is the tax shield on depreciation. Because of depreciation, our tax is getting increased. Okay, because of depreciation, our tax is getting reduced. Okay, now suppose I have to pay profit. If my profit is 100 rupees, I will pay 30 rupees taxes. Okay, if 30% is the rate. But because of depreciation, if my profit is becoming 80 rupees, then I only have to pay 24 rupees taxes. So this 6 rupee taxes is there now. This 6 rupees is what is called as tax shield on depreciation. This is the benefit that I'm getting. So second way of doing this is that you directly add back the tax shield on depreciation. You have two methods to find out the cash flows. One is do this method. Directly calculate the PAT, and from that PAT you add back the depreciation. This is the logical way and the easiest way. And the second way is you find out the PAT, you reduce interest, reduce taxes, and then don't reduce depreciation, directly add back the tax shield on depreciation. So that is the second way of calculating. Usually, I would suggest you to do the first way of calculation, because this is the logical way. Okay, I will also do one problem in capital budgeting, just for your comfort, because we are having some time, so we can afford to do one problem in capital budgeting. So estimation of cash flows is completed. Okay. Now let us go into the concepts. Let us go into the concepts. Okay. First technique, what we are discussing is payback period. First technique is payback period. Payback period is similar to what we study in break even. In break even, what you will do, the number of units where profit is zero. The number of units where, so here we will just see the period. At what period my total investment I am recovering. In what period? Okay, it is the period. Okay, it is the period. So whenever you are having a payback period, what you are doing is, actually suppose if you are investing 1 lakh rupees. Okay, the life of the project is 7 years and you are getting 20,000 rupees every year. So in which year my entire investment I will get? In which year my entire investment I will get? So 20,000 first year I will get. Second year I will get 20,000. So 40,000 I recovered. From 1 lakh I invested 40,000 I recovered. Then again I got 20,000. 60,000 I recovered. 3 years I recovered 60,000. Fourth year I recovered 80,000. Fifth year alone I will recover the investment. And whatever I will be earning from the 6th year is my extra, is my profit over and above my investment. Okay, 6th year and 7th year I am starting to make profit, so it is like break even. So payback period, it is a period, okay, it is a period within which, okay, the cost of the project or the investment amount, within which the cost of the project or the investment amount is recovered. Slowly my handwriting is becoming bad, so bear with me. So payback period, it is a period within which the cost of the project or investment amount is recovered. See, the normal way of computing is 0th year, okay, year and cash flows. 0th year you're investing 2,50,000 rupees, okay. Now first year, second year, third year, fourth year, fifth year, sixth year, seventh year. The life of the project is 7 years, okay. You are getting 50,000 rupees, 50,000 rupees, 50,000 rupees, 50,000 rupees, 50, 50, and 50. Okay. So if you see here, I've invested 2,50,000 rupees, and how much amount I got actually? I got 3,50,000 rupees. Okay, I got 3,50,000 rupees in total. But in which year? In which year I've totally received this amount is what is payback period. So if you see 50, 1 lakh, 1 lakh 50, 2 lakh, 2,50,000. So if you see 5th year, I recovered my investment. So I can say my payback period is 5 years. This is the conceptual way of understanding, but in exam, don't write like this. I will give you a proper formula. Whenever the cash flows, okay, if there are annuity cash flows, two types of cash flows are there, right? Annuity cash flows and uneven cash flows, okay? Annuity cash flows, and second one is the cash flows are uneven, okay? Cash flows are uneven. So here, if you see the cash flows are even. So here you can use a shortcut formula. What is the shortcut formula? Investment amount, okay, investment amount, or the cost of the project, investment amount divided by, okay, investment amount divided by annual cash flows. If you see, you will get 2,50,000, the whole divided by 50,000. The answer will be 5 years. The answer will be 5 years. Whenever you're having annuity cash flows, this is the formula that you can use. Investment amount, which is the cost of the project, divided by annual cash flows. You can write either investment amount or cost of the project, okay? Or cost of the project. Because the cost of the project is alone what you're investing. In textbook, the word cost of the project is given. Second one, this is also logical. Second one, if the cash flows are uneven. Now, if you see, if the cash flows are uneven, suppose you have invested under year 0, you have invested 1 lakh rupees. But first year, second year, third year, the life of the project is only 3 years. First year, you are getting 30,000. Okay. Second year, you are getting, say, 90,000. Third year, you are getting 20,000. Now, if you see your amount is recovered in second year, but in second year you got 1,20,000. You wanted to recover only 1 lakh. So what is the break even period? So you know it is somewhere in the between 1 and 2. It is somewhere between 1 and 2. Okay. Or what I can do, let me put it 70. Okay, let me put it 70. Now, if you know directly, you can calculate. You got the payback period of 2 years. Okay, your payback period is 2 years. But how will you calculate? How will you calculate? For that, you always have to prepare a schedule. Always remember, under whenever a payback period comes, you won't get an annual cash flow. You will get multiple uneven cash flows only. Whenever multiple uneven cash flows come, you have to prepare a schedule. What is this schedule? Year cash flows. Okay, ignore the zeroth year. Year cash flows, and then you have to put cumulative cash flows. Cumulative cash flows. 30,000, then 30,000 plus 70,000 will become 1 lakh, then 1 lakh plus 20,000 will become 1 lakh 20,000. You have to prepare the schedule, year, cash flows, cumulative cash flows. Then from the cumulative cash flows, you have to see where the investment amount you are recovering. Your investment amount is 1 lakh rupees. So if you see 1 lakh rupees you have recovered in 2 years. So you can say your payback period is 2 years. Okay, you can say your payback period is 2 years. But I'll try to write nicely. But suppose, okay, but suppose if your investment, if your investment is in between some value, see here it is very straightforward. It is very straightforward. Second year directly you got 1 lakh rupees. But what if second year it is not 1 lakh, it is 1 lakh 20,000 rupees, or it is 1 lakh 10,000 rupees? Then you know that your answer is somewhere in the middle of 1 and 2. It is 1 year and few months. So how to calculate that is what you're going to see. I know you already know this, but let me do for few people if they don't know this concept, if this revision will become a motivating for them, that yes, at least because of this revision I understood one concept which I actually left. Okay, so cash flows, year 1, 2, 3, 4, your investment amount is 1 lakh rupees. Okay, your cost of the project is 1 lakh rupees. First year, how much amount you got? You got 40,000 rupees. Second year, you got 30,000 rupees. Third year, again, you got 35,000 rupees. And fourth year, you got 20,000 rupees. So whenever multiple uneven cash flows comes, what you have to do? You have to prepare a schedule. Year cash flows and cumulative cash flows. Okay, cumulative cash flows. So cumulative cash flows. First is nothing, 40,000. Second is 70,000. So second year also I didn't recover. You just see second year I didn't recover. Now here I got 1 lakh 5,000 rupees. 1 lakh 5,000 rupees, and this will become 1 lakh 25,000 rupees. Now if you see third year I recovered, but third year I wanted to recover 1 lakh, but I recovered 1 lakh 5,000 rupees. Now how should we calculate the payback period? How should we calculate the payback period? Now 2 years it is good, pa. 2 years it is good. It is somewhere in between 2 or 3. 1 lakh is somewhere in between 2 and 3. This is what you understood, pa. 1 year is in between 2 and 3. Now, how will you calculate the payback period? Okay, payback period. You know that it is somewhere in between 2 and 3. Now, 2 years and how many months is what now you are going to identify. Let us see. 1 minute. If someone is having any doubt, 1 minute. Okay. Okay, pa. Okay. So, where were we? Yeah, payback period. So, if you see here, 1 lakh rupees is the investment amount. So 1 lakh rupees is lying in between 2 years and 3 years. Okay. So 2 years is same. Okay. 2 years. Now you want to find out the fractional year within which you have actually calculated 1 lakh rupees. So 70,000 rupees. Okay. 70,000 rupees you already recovered from year 2. Now, what is the amount that you want to recover in year 3 to get 1 lakh rupees? What is the amount you want to recover from year 3? If you see 30,000 is the amount you want to recover in year 3. What is the amount that you want to recover? 30,000 is the amount you recover in year 3. But in year 3, how much you have earned? In year 3, you have earned 35,000 rupees. See, if you see in year 3, how much you have earned? 35,000 rupees. So what actually you're doing is that, okay, there may be a possibility 11 months you have calculated, correct? 11 months you got the amount. So you wanted 30,000 rupees and how much you got? 35,000 rupees. So what you're doing, you're finding the fractional year where this 30,000 rupees and you will stop. Okay, this is what you're doing. Now 2 years is what you are. If 2 years, after 2 years, what is the fractional amount is what we are calculating. Now 30 divided by 35,000. 30,000 divided by 35,000, you're getting 0.86 years. Okay, so 2.0.86. So it is 2.86 years. Okay, it is 2.86 years. Or if you want to calculate in months, what you have to do? 2 years, 2 years and 0.86 you want to multiply into 12. So you will get 10 months. Okay, you will get 2 years and 10 months. Either you can write the answer 2.86 years, or you can also write 2 years 10 months, or you can write both. Okay, you can write both. It is better you stop it here because institute stops here. But if it is, but conceptually it is better to write in months. So you write both, but it is not an issue. 2.86 years or 2 years and 10 months. Okay, 2 years and 10 months. Okay, 2 years and 10 months. This is the concept of payback period. Now let us go. The next concept is nothing. It is again discounted payback. Discounted payback. The only difference why we are calling this as traditional method and why we are calling this as modern method is that in traditional method, time value of money is ignored. In traditional method, no time value of money concept is used. In modern techniques, time value of money concept is used. That is why it is called as traditional techniques. This is called as modern techniques. Now let us jump into modern techniques. This is what is very important. So if you see modern techniques, what we are doing is that we are actually calculating from normal cash flows, correct? But what is happening, you cannot add cash flow 1 and cash flow 2. You cannot add cash flow 2 and cash flow 3. Why? Because there is a time gap. So what you have to do, you have to discount the cash flows and then you find out the cumulative cash flow and then you find out the payback period. So this is what is the discounted payback. So discounted payback, suppose you are having an investment of 1 lakh rupees. Okay, suppose you're having the investment of 1 lakh rupees. So year 1, 2, 3, 4, 5, and suppose you're getting the cash flow as 30,000, 40,000, 40,000, 50,000, and 30,000. What you have to do is first you have to calculate the discounted cash flows. From cash flows, you have to find out the discounted cash flows. Remember last class, I told you how to calculate discounted cash flows. I told you different types of cash flows are there. Single cash flow, now how to find out the discounted cash flow. Annuity cash flow, now how to find out the discounted cash flow. And uneven cash flows. So these are uneven cash flows, now how to find out the discounted cash flow. I already told you. What is discounted cash flow? How to find out discounted cash flow? Cash flows into present value factor. So what you have to do now, you have to calculate the discounted cash flow. The table will alone change. Cash flows, present value factor. Suppose the present value factor is 10%. You just write the present value factors, okay? 0.909, 0 point, okay? All the present value factors you write. And then you will multiply cash flow into present value factors, okay? You will get discounted cash flows. Now, from this discounted cash flows, you have to find out the payback period. So, discounted cash flows, what you have to do? Cumulative discounted cash flows. Do cumulate this discounted cash flows, and from this discounted cash flows, identify in which 2 years 1 lakh is getting covered. And same method you do, but don't use this cash flows for calculation. Use this cash flows for calculation. Discounted cash flow, and then find out the discounted payback period. Nothing special is there. The only difference is that there cash flows without time value of money is used. Here cash flows after considering the time value of money is used. Discounted cash flow period. So the total of this is discounted cash outflows. Okay, discounted cash outflows. Sorry, inflows. You're getting the money. Discounted cash inflows. Okay. Again, a small revision. Whenever any problem comes, always remember a schedule. Discounted payback, now always remember the schedule. Year, cash flow, and cumulative cash flow. If it is discounted payback period, then year, cash flow, present value factor, discounted cash flow, and cumulative discounted cash flow. Cumulative discounted cash flow. Cumulative discounted cash flow. Once you fill this, then you have to identify this, and then you'll be able to solve the problem. So all these are outflows. Okay, all these are inflows. Sorry, inflows. Outflow you will have in year 0. Under year 0, you will have the outflow. Year 1, 2, 3, 4, whatever the amount you're receiving, that is an inflow. Under financial management, inflows are written in negative. So that is the reason I write in year 0, if you're investing 2,50,000 rupees, in outflows are always negative and inflows are always positive. Because inflow we are receiving amount, outflow the amount is going. So whenever the amount is going out of the company, that is negative. This is how you have to write year and cash flows. Now year 2,50,000, you got 1 lakh, 1 lakh, and 1 lakh. Now we will see net present value. Net present value is very important. See, this is a simple problem of net present value. In exam, it will not come. Okay, in exam, net present value problem will not come because cash flows will not be directly given. In exam, you have to identify the cash flows. Okay, you have to identify the cash flows. But let me tell you how to find out the discounted net present value. You already know. I will tell you first what is net present value. Net present value is discounted cash inflows minus discounted cash outflows. This is what is net present value. This is what is the net present value. Mm, 1 second, for some glitches there. 1 second. Now it's done. Okay. So net present value, the formula for net present value is net cash inflows minus net cash outflows, but you don't have to remember the formula. Always remember the schedule, always remember the way, always remember the approach of how to do the problem. So how to do the problem, first will be the particulars. Okay, particulars, year cash flow. So this will be cash outflow. Okay, these are the inflows, then year, then cash flow, then present value factor. Okay, present value factor, and then discounted cash flow. So this is an outflow, and you already know that for year 0 present value factor will always be 1. And then suppose if it is 10% or 0.909 0 point, so all this present value factor you have to write, multiply the cash flow with present value factor. Okay, 2,50,000 rupees. Suppose this is okay 9,09,000. So all this you have to add, and then you will get the net present value. You will get the net present value. This net present value can either be positive or it can be negative. Okay, the net present value is can either be positive or it can be negative. Now let me tell you the concept. Let me tell you the concept. What is the net present value? Suppose you are having the project investment of 2,50,000 rupees, and if you are receiving some inputs, okay, and if you are receiving some inputs, what you are going to do is that you are finding the net cash. Okay, if you are discounting the entire amount with 10 percentage, or if you are discounting the entire amount with 15 percentage, what is the amount that is remaining? What is the amount that is remaining? It can be positive also, it can be negative also. Suppose if it is positive now, after having this 10 percentage, you are remaining some amount. So that is why it is net present value is positive. So net present value is nothing but it is the total of the net cash. It is total of net cash. Net cash now after considering the time value of money. So for exam perspective, net present value, now this table you have to remember. Year, cash flows, present value factor, then discounted cash flow. So discounted cash flow, now this is discounted outflow and this is discounted inflow. Once you total this, that means discounted cash inflows minus discounted cash outflows, you will get the net present value. If net present value is positive, accept. If net present value is negative, reject the project. Okay, if net present value is positive, accept the project. If net present value is negative, reject the project. Decision, how to take a decision is what now I'm going to tell you. See, whenever you are doing payback period, the lower the payback period, okay, the lower the payback period, it is better, correct? So for payback, lower is better. Okay, lower is better. Why? Because if one project is paying me back in 5 years, but the second project is paying back the amount at 4 years, then which is better? 4 years is better. So now this is the decision rules. Okay, these are the decision rules. Under payback, lower is better. If two projects are given for you and if payback period is asked, then lower the payback is better. If NPV is asked, then higher the better. Okay, now project A is having an NPV of positive 1 lakh rupees. Project B is having a positive NPV of 1,50,000 rupees, which means after removing this cost of 10 percentage, still I'm remaining some amount, right? Still, if I'm remaining some amount, so wherever that remaining amount is more, that will be better. See, if only one project is given, then positive negative rule we have to take. But if multiple projects are given, then you have to take some decision which project to accept. Then this decision rules you have to take care. Okay, payback period and negative payback period and NPV. Under net present value, higher the better. Payback period, lower is the better. Okay, many people have this confusion. Payback period, two project is given 6 years. Okay, higher the better. They just go and write the answer. But see the concept. Whenever we are recovering the money sooner, correct, the sooner the I'm recovering the money, that is better for me. So payback period is lower the better, NPV higher the better. Okay. Now next one. Next one, profitability index. I'm going a little slow because Very important chapter. Two questions are expected. Okay, one question is coming, then one good mark question will come, or two small questions can come. Okay, profitability index. Profitability index, directly I can give you the formula. The formula is this discounted, okay, total discounted cash inflows divided by total discounted, okay, cash outflows. Now, just an example I'm taking. My discounted cash outflow, okay, my discounted cash outflow will be usually negative only, correct? So suppose I have invested 1 lakh rupees. Okay, I've invested 1 lakh rupees on year 0. So this is my discounted cash outflow. And let's say my discounted cash inflow is 1,20,000 rupees. Okay, 1 year, 2 year, 3 year cash flows are given. I've discounted all the cash flows and I got a discounted cash inflow. Okay, so my discounted cash inflow, okay, my discounted cash inflow is 1,20,000 rupees. Under NPV, what you will do? Discounted cash inflow minus discounted cash outflow, and you will write the answer. If it is positive, you accept. Okay. So this is one way of telling, that is in number way of telling. In ratio way of telling, this is the same thing. What you're doing, you're not minus discounted cash inflow minus discounted cash outflow. You're dividing discounted cash inflow divided by discounted cash outflow. So what is a discounted cash inflow? It is 1,20,000 rupees. What is discounted cash outflow? It is 1 lakh rupees. So what is my profitability index? It is 1.2. So profitability index, if it is more than 1, then you have to accept the project. Because just for an example, imagine if it is 80,000 rupees, this will become less than 1 and your NPV will become negative. NPV and profitability index always go in the same direction because same numbers we are using. That is, you are giving in absolute value and this is you are giving in ratios. Okay, this is the only difference. Profitability index, nothing new is there. Discounted cash inflow divided by discounted cash outflow. Net present value, discounted cash inflow minus discounted cash outflow. Under net present value, positive you have to accept, negative you have to reject. Under profitability index, more than 1 you have to accept, less than 1 you have to reject. Okay, 1 means NPV is discounted cash inflow is equal to discounted cash outflow. Your decision becomes indifferent because many times this question comes, okay sir, positive, negative, I know. What is if NPV is 0? If NPV is 0, which means it is indifferent. Now, profitability index, discounted cash inflow divided by discounted cash outflow. And here what is the decision rule? More the, okay, more is better. The profitability index also, more is better. If for project 1 profitability index is 1.2, if project B profitability index is 1.5, which means this is better. Why? Because here NPV will be more, right? Because here profitability index is more. Now one more thing, very important thing, profitability index is also called as desirability factor. Okay, one time in exam, I think first time, uh, November 17 or November 19, they asked what is desirability index. Okay, that was the first time this word were used and no one was aware of that. So they didn't know that this is profitability index. So desirability factor, this is another word which is used. Okay, desirability factor. Profitability index is also called as desirability factor. Okay, profitability index. Now here one more connected topic. This also happened in one of the examination. In one of the examination, what happened is that in one of the examination, they asked to find out the net present value index. What many students did, they found out the net present value and they completed the answer. But what they asked, net present value index. So net present value index is not there. See, it is something similar to profitability index only. What is net present value index? It is nothing but instead of cash inflows, what they are doing, NPV. They are directly doing NPV minus discounted cash outflow. Discounted cash outflow. which means discounted cash inflow minus discounted cash outflow divided by discounted cash outflow. That is what is net present value index. So net present value index more than 0 is good. Okay, more than 0 accept, less than 0 reject. There more than 1 accept, less than 1 reject. Here more than 0 accept, less than 0 reject. Why? Because if NPV is negative, it will become negative. Then net present value will also become negative. If NPV is positive, then this will become more than 0. Correct. So this is net present value index. In one such examination, this question is asked. Many students did a mistake. They directly put a net present value. So if any time, in case if it repeats, net present value index is coming, you should know what is net present value index. Net present value index is nothing but NPV divided by discounted cash outflow. Or they can also use this word net profitability index. That was profitability index, and this is net profitability index. Okay. Just small crispy points I'm telling you, so that you should not make mistakes in examination. Okay, why I'm discussing all these points is that at this point in time, if you're aware, because at this point in time you all are matured enough, because you have read financial management, so you're matured enough to solve the problem. But these small crispy small points, if you're able to remember and retain in the mind, examination will be a bit easier for you. So net profitability index we completed, NPV we completed. Next one. Next one, very important, internal rate of return. Internal rate of return is also called as IRR. Okay. Now, what is internal rate of return? Internal rate of return, it is the actual return from the project cash flows. From the project cash flows. What is this actual returns per now? So till the time we were discussing fake returns, no, see, actual return from the project cash flow means, see, you were doing NPV, correct? When you were calculating NPV, suppose you were calculating the present value factor 10% and your NPV was coming as positive 20,000 rupees. Okay, positive 20,000 rupees. So at some point in time, this NPV should become zero, correct? Because if you're putting 10%, still you're having some value. If you put 11,000, maybe this 20,000 will become 18,000. If you put 12%, maybe it will become 10,000 rupees. If you put, so at some point, okay, at some percentage, what percentage your NPV is becoming zero? So it is the rate, okay, it is the rate at which your NPV is becoming zero. Your NPV is becoming zero, which means the rate at which all your cash flows are discounted equally with the cash outflows to make it zero. So that will become the actual return and nothing is remaining, because that is how you will calculate the actual rate. Okay, that is how you will calculate the actual rate of return. The actual rate of return is calculated by IRR. So IRR is nothing. IRR is the rate at which NPV is becoming zero. It is the actual return from the project cash flows. So here we are not taking any rate. What we are doing is we are calculating the rate. We are calculating the rate, and in that rate, NPV will become zero. Now, assuming that it is very difficult, correct? See, under 10%, if you're having a positive NPV of say 20,000 rupees, okay, at 10%, you're having a positive NPV of 20,000 rupees. Okay, then at some rate, okay, once you're increasing the rate, because when you're increasing the rate, your NPV will be your NPV will reduce, correct? Suppose 12%, your NPV is becoming say 10,000 rupees. Just an example, okay, just an example. You increase the rate. At some percentage, it will become zero, correct? So directly you cannot identify, okay, there can be a possibility 13.75% this will become zero. So how to calculate this 13.75 is what the issue is, okay, is what the issue is. I'll directly tell you the method. I'll directly tell you the method. The method of calculating IRR is first one, okay? First one, the method of calculating the IRR is take two NPVs, okay? Take two NPVs, I mean take two rates, okay? Take two rates such that one NPV should be negative, okay? one NPV should be negative and other NPV should be positive. And other NPV should be positive. So what is this rate? I will explain in some time, but first you see the steps. First is take two rates. Sir, how to take the rate? I will tell you that also. First is take two rates such that one NPV should be negative and another NPV should be positive. Now what is happening here? Suppose if this is the NPV table, so here suppose you are having a negative NPV of 20,000 rupees. Okay. Suppose here you are having a positive NPV of 10,000 rupees. This was say a positive 10 percentage, and this you have reduced it. Okay, you have increased 1 minute, 1 minute, 1 minute. Under 10%, you are getting a NPV of 10,000 rupees. Then you increase the rate. Okay, you increase the rate to 15 percentage, and then you got the NPV of minus 20,000 rupees. Now, what is the rate at which the NPV is becoming zero is what you have to find out. Zero is what you have to find out. So, how you will find out? You will interpolate, because you know the answer is somewhere between 10 to 15. Because 10, I was getting an NPV of 10,000 rupees. Okay, I was getting an NPV of 10,000 rupees. Under 15, I'm getting a negative NPV of 20,000 rupees. So somewhere, okay, return and NPV are, inversely proportionate. So positive, negative, many confusions will be there. Only if I solve one problem, I'll get to you will understand how to calculate IRR. Okay, so this is what you have to do. And then what you have to do, you have to interpolate it. You have to take two rates. One should be positive, one should be negative, and then interpolate those two rates. Okay, interpolate two rates to find out NPV. To find out NPV, two methods are there. Okay, one is the formula method, another one is the conceptual method. I will discuss both the methods. Usually I follow conceptual method, but if someone feels easy to remember the formula, they can also follow the formula method. One is the formula method. So one is the formula method, another one is the conceptual method. Another one is the conceptual method. See, the formula method, how to interpolate. If you have two rates, then IRR is equal to lower rate plus, see, why are formulas are easy because you have the numbers with you. You directly put the numbers in the formula and then you will get the answer. That is the reason formulas are easy. But at the same time it is difficult, because what if you are not able to remember the formula? That is the reason you should also know the concept in your mind. Okay, let me tell you the formula. Lower rate. Okay, LR means lower rate, and then you have to do lower rate plus NPV at lower rate, the whole divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. This is the formula. Okay, lower rate, higher rate. As I said, you should have two NPVs and two rates. Okay, you should have two NPVs and two rates. One will be NPV of lower rate, one will be lower rate, and one will be higher rate. So you will have NPV 1, okay, and then you will have NPV 2. One will be positive and one will be negative. Okay, NPV at lower rate will be positive, NPV at higher rate will be negative. Okay, this will be negative and this will be positive. So what you have to do is that you have to find out two rates, and from those two rates you have to find out the interpolation. So this is the interpolation formula. This is the interpolation formula. Conceptual method I can only explain when solving a problem. So I will solve a problem and then I will tell you how to conceptually. So IRR, if you have two rates, okay, lower rate and higher rate, how to find out the rates I will tell you now. NPV1 and NPV2 you will find out, positive and negative. Now, whenever any IRR problem comes, first thing is you have to remember the table. Okay, year, cash flow, okay, present value factor at say some percentage you're calculating, say you're calculating at 12% discounted cash flow. Then you have to see what is the amount that you're getting. Okay, what is the amount that you're getting? Suppose you're getting a positive amount. Okay, suppose you're getting a positive amount. So you have to increase the rate, then you will get a negative amount. Then what you have to do, again you have to put present value factor, because this is the lower rate. Now you should get the higher rate. So present value factor, suppose say now you're doing for 15%. Okay, 15% you're doing. So now cash flow into present value factor, you will get discounted cash flow, and this is for lower rate and this is for higher rate. Okay, this is for higher rate. Now if you see, this will be the higher rate. Here you will get a positive amount, here you will get a negative amount. Okay, this is the table. Here cash flow, present value factor, discounted cash flow at lower rate, present value factor, discounted cash flow at higher rate. So positive NPV you will get, negative NPV you will get. So from this, if you apply this formula, lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate, you will get the IRR. Okay, you will get the IRR. This is what is IRR. See, IRR looks difficult. Okay, IRR looks difficult, but once you make this table, it becomes very easy. You know, when you see this formula, many students are scared by seeing this formula. That is where there is one thing called conceptual method. So what I will do now, after I will take a small, we will take a small 10-minute break. Okay, 11:30. We will solve one good problem in capital budgeting for techniques. I'm thinking of solving two problems. One, a technique problem, and second one will be a good case study problem if time permits, because you know it becomes little lengthy for you to explain this case study. Okay, so first I will solve one problem where NPV will be there and IRR will be there. That problem I will solve you to gain some comfort, and then we will go into this second type of problems. Okay, NPV and IRR, profitability index, everything we completed. So now we are in the end of the capital budgeting chapter. Okay, so after the break, 11:30 we'll meet. We'll take a 10-minute break. 11:30 we will meet again, and then we will do one problem. You also do the problem with me, because one problem is very important. Even before the exam, I suggest you to do one problem of NPV and IRR, because here most of the silly mistakes are possible. Okay, so let us meet after the break. Okay, so let us continue now. So we were discussing about IRR. We were discussing about IRR. Now let us go real quick. I told you what are the steps of IRR. First, take two rates. Okay, take two rates and find two NPVs. Okay, one positive and one negative. After finding that, directly put the formula. Okay, lower rate plus NPV at lower rate, the whole divided by NPV at lower rate, the whole divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. The best part about the formula is that just have the formula, plug in the numbers, you'll get the IRR. And the worst thing about the formula is that you have to memorize this formula, and if you are not able to remember the formula in the exam, your whole question gets messed up. So that is the reason always know the concept also. Now let me tell you the concept. So before telling into concept, let me solve one problem. Okay, let me solve one problem to have one comfort. Okay, so these are all case study problems. So one more thing, whenever you're solving any problem, okay, please solve, from different sources. Okay, only study material is not enough. Let me tell you, only study material is not enough, at least for financial management. Even though many questions are there, but still study material is not enough. Study material also, you see the problem in different sources mean I'm not asking you to buy any book. Institute only is having RTPs, MTPs and previous year papers. These three sources right now for past 1 year alone you do, that is enough. Okay, for this time. So okay, this is the problem. See, if you see this problem, first they ask you to find out the net present value of the project at 15% rate. Then they ask you to find out the analyze what would be the net present value at 10% rate. And then they ask you to find out the internal rate of return, and then they ask you to find out the project's payback period. Okay, project's payback period. Read the question first. Considering a new product line to supplement this range of product, it is anticipated that new product line will involve cash investment at of 7 lakh rupees at time 0. Okay, so if you see 0th year, 7 lakh rupees is outflow. Okay, and 10 lakh rupees in year 1. So year 1 also they have an outflow. Okay, after tax cash inflows, see, directly cash inflows are given. After tax cash inflows of 2,50,000 are expected in year 2. So year 2, 2,50,000 rupees. Year 3, 3 lakh rupees. Okay. Year 4, 4 lakh rupees. In year 4, sorry, 1 minute. 3,50,000 in year 4. Okay, 3,50,000 rupees in year 4. So we have 3,50,000 rupees in year 4. Then year 5 to year 10 we have 4 lakh rupees. This is what is the estimation of cash flow. This is the first step that you have to do. Okay, year and cash flow. Write down all the estimation of cash flows. 0, 1, 2, 3, 4 and 5 to 10. I already told you this is mid annuity. Whenever you have mid annuity question, what to do? First you find out the annuity factor of 1 to 10. And then you reduce the annuity factor of 1 to 5. You will get the mid annuity of 5 to 10. Now see in here, if the rate is 15%, okay, present value factor at the rate 15%. All this is easy to find out. Let me tell you this number. Okay, because see, one method is 5, 6, 7, 8, 9, 10, 4 lakh, 4 lakh, 4 lakh, 4 lakh. You're writing all the value, that will be time consuming. So what you have to do is you have to find out the mid annuity of 5 to 10 years. How to find out the mid annuity of 5 to 10 years? First, find out the annuity factor of 1 to 10 years, then reduce the annuity factor of 1 to 5 years. How to find out the annuity factor of 1 to 10 years? Okay, first thing is 1 divided by 1.15. Okay, 1 divided by 1.15. You have to calculate it 10 times. So annuity factor 10 times and then grand total, or equal to m plus equal to m plus 10 times, and then you memory recall, you will get the sum of all the present value factors of 10 years. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Now if I do the grand total, I am getting 5.019. Okay, this is 5.019. Okay, 5.019 minus, I have to do the annuity of 1 to 5 years. Okay, so 1 divided by 1.15, 1, 2, 3, 4, 5. I am getting minus 3.352. Minus 3.352. Now if I reduce 5.019 minus 3.352, I am getting 1.667. Okay, 1.667. So this is my annuity factor for 5 to 10 years. Let us check. 1.667. You're getting 2.163. 1 minute. 1 to 10 years. 1 divided by 1.15. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Okay, you're getting 5.018, and then you have to reduce for 5 years. So 1 divided by 1.15. 1, 2, 3, 4, 5. You're getting minus 3.352. I'm really sorry. I'm really sorry. 1 to 10 years minus, because you want 5 to 10, right? So you have to first, you have to reduce annuity factor for 1 to 10 years, and then 1 to 4 years alone you have to minus, not 1 to 10 years. So 3.352 will not come. 1 to 4 years, because it is 5 to 10. So 1 to 10 and then 1 to 4 you have to reduce, then you will get 5 to 10 years. So 1 divided by 1.15. 1, 2, 3, 4. You are getting 2.855. So once you do minus 5.018, you will get 2.163. Okay, 2.163. This is how you have to calculate the mid annuity. How to calculate the mid annuity? First, find out the present value annuity factor for 1 to 10 years, and then reduce the present value annuity factor for 1 to 4 years. You will get the present value annuity factor for 5 to 10 years. Clear? So this is what is one new point. Okay, this is what is one new point that you have discussed. Or the second method, if you're feeling this is very confusing, you extend the table till 10, but that will be little bit time consuming. Nothing wrong, you can do that. Okay, now next one. Once you found out everything, see, this thing you can already find out. You can already find out, and you will get the net present value for 15 percentage rate. Same thing you do for 10 percentage rate, you will get the net present value. Okay, you will get the net present value. Now this is the IRR as per formula method. This is the IRR as per formula method. Now let us see the IRR as per the conceptual method. Okay, see, conceptual method, formula method, nothing different is that. It is just that it is brought into a concept. Now let me tell you, in 15% rate, what was the NPV? 15% rate, the NPV was negative 1 lakh 18,200 rupees. Okay, 10% rate, what you got as the NPV? You got as 2,51,450. 2,51,450. Now using these two rate only, you will find out. See, now you have two NPV, one is positive, one is negative. You will be able to find out the NPV. Now what you have to do is that first, just for visualization purposes, I'm drawing a line. Okay, This is negative 1,18,200. Okay, and this is positive 2,51,450. Okay, this is for 10 percentage rate. This is for 15 percentage rate. Now see, if my rate was 10 percentage, okay, I increase my rate to 15 percentage, my NPV become negative. What I want is the rate. What I want is the rate at which my NPV should be 0. This is what I wrote, correct? 10 percentage, some increase in 10 percentage, I should get NPV as 0, correct? This is what is my ultimate objective. Now what I am doing is that I'm analyzing. See, I'm analyzing my increase. If I increase my rate to 5 percentage, how much my NPV has decreased? If you see, my NPV has decreased from 2,51,000 to negative 1,18,200. So when I increased my rate to 5 percentage, what my NPV reduction is? So if you see, first my NPV is reduced to 2,51,000, then again reduced to 1,18,200. So if you see, my NPV has reduced to 2,51,450 plus 1,18,200. So 2,51,450 minus of minus 1,18,200. Are you all understanding? From 2,51,450 to 1,18,200, what is the amount of reduction? The amount of reduction is 2,51,450 plus 1,18,200. It is 3,69,960 is reduction, correct? So 3,69,650. By increasing my rate to 5 percentage, my NPV has reduced to 3,69,650. Till this you're clear? Okay, till this you're clear. You can just put it in the chat box, so I'll get to know. Okay, till this you're clear. Okay, so you have increased the rate to 5 percentage, and now you're getting an just 5 percentage. My NPV has reduced to 3,69,650. Till this you're clear. Okay, till this you're clear. You can just put it in the chat box, so I'll get to know. Okay, till this you're clear. Okay, so okay, so if you see, your NPV increased to 5 percentage, but your rate increased to 5 percentage, but your NPV has reduced to 3,69,650. Now, how much increase in rate I want? How much increase in rate I want to reduce my NPV? What is the NPV that I want? 0. So how the NPV will become 0? How the NPV will become 0? If I reduce from 2,51,000, what amount I should reduce to bring it to 0? I should reduce 2,51,000, correct? So I should reduce 2,51,450. If I reduce this 2,51,450, I will get my NPV as 0. So by 5% increase in rate, my reduction is 3,69,650. What increase in rate my NPV should reduce to 2,51,450? We want to find out. Okay, this is the amount that we want to find out. What you have to do, just do cross multiplication, average only, right? So what, just do cross multiplication. 2,51,450 into 5 divided by 3,69,650. What is the amount that you're getting? Okay, 2,51,450 into 5 the whole divided by 3,69,650. You are getting 3.4, which means your NPV should increase. Your NPV should increase by what? 3.4. So what should be your NPV? Your NPV should be 13.4 percentage. So this amount, okay, so this amount. So IRR is equal to 10 percentage plus 3.4 percentage. It will become 13.4 percentage. If you see here, your NPV is 13.4 percentage. This formula is made by this concept only. If you see what we are doing, for this phi is nothing but higher rate minus lower rate. This phi is nothing but higher rate minus lower rate. This 2,51,450 is nothing but NPV at lower rate. So NPV at lower rate divided by this 3,69,650 is nothing but NPV at lower rate minus NPV at higher rate. So NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate plus. This is how is the formula is made, and this is how you understand it conceptually. Suppose if you forget the formula, by concept at least you know, okay, what you have to do. At least in plus minus you will not be confused. Okay, so this is how you have to calculate the IRR. So I spent a little bit more time in IRR because these are the concepts where you should not afford to lose even a single mark. If you're losing even 1 mark means it is a, it is a bad impression. It is a bad impression on you also, on me also. Okay. So because these are very clear cut concepts that you should understand. NPV completed, IRR completed, profitability index, payback period, everything is completed. Okay, so this problem, payback period. Okay, payback period, wherever it is becoming zero, as you see in the 6th year it is becoming zero, so directly. But you don't do this method, always make a table. Okay, always make a table. Here, okay, here the investment was 1 lakh, here the investment was 17 lakhs because 10 and 7. So when the 17 lakh is coming, 2 lakh 50, 3 lakh. So cumulative cash flow, if you put 3 lakh, then 5 lakh 50, then 5 lakh 50, 9 lakh, then 9 plus 4, 13 lakhs, and then plus 4, 17 lakhs. If you see on the 17 lakhs, it will come on year 1, 2, 3, 4, 5, 6. So on the year 6, you will get 17 lakhs. Okay. You have to make a table like this. You have to make a table like this. Just put a cumulative cash flow table here. If you put the cumulative cash flow table here, from here it will start 2,50,000, then it will be 5,50,000, then 9 lakh. Okay, 9 plus 4 will become 13 lakhs. Then put year 6. Okay, year 6 again 4 lakhs will become 17 lakhs. So if you see this 17 lakhs, their total investment. So one mistake people do is they take only the 0th year value. You should not take only 0th year value. You should take total outflows. So here your investment is not 7 lakh, your investment is 17 lakh. This is one new point. So 17 lakh you got in year 6. So payback period is year 6. Okay. So one question we solved. This is what is NPV and IRR and payback period. This is how a typical problem looks like. Done. And let's go ahead. Let's go ahead. Now we are coming into the second type of problems. Okay, second type of problems, what you will get is case study based problems. Okay, case study based problems. Under case study based problems, I am giving you the approach. The first approach is you have to read the question. Okay, first always read the question. Any case study based problem, don't see if it is a normal problem, directly see what is required. Okay, directly see what is required. Under case study problem, first see what is required and then read the problem properly, only then start to solve. Okay, so now here read the question properly. Here read the question fully and mark. Wherever cash flows are there, you just mark and mark the cash flows. Because in an entire question, wherever cash flows are given, you just mark it, and that to relevant cash flows you mark. Okay, relevant cash flow you mark. Okay, so this is what is the first step. Identification of cash flows is completed. Okay, estimation or identification of cash flows is completed. Second, cash flows you always have to bifurcate into 3. See, remember this approach, it will become easier for you to solve any capital budgeting problem. Cash flows, first it will be initial cash flows. Okay, initial cash flows. Then it will be annual cash flows. And then third one is the terminal cash flows. Okay, initial cash flows, annual cash flows, and terminal cash flows. Always, whenever you are solving a problem, first you write a note. Okay, working note 1. Initial cash flows. Okay, initial cash flows. Now, whenever you're having any initial cash flows, usually what will be the initial cash flows? It is an outflow. Okay, I'm just taking a problem, it is an outflow. Usually it will be an outflow. So the cost of the new asset. Okay, cost of the asset, it will be an outflow. Okay, this is an initial cash flow. Initial cash flow now, always the cash flow at year 0. Okay, year 0 na initial out cash flows. So cost of the asset. Then if there is any installation, okay, if there is any installation, installation cost. That is also an initial cash flow. All this cash flow you have to put and then you have to total. Okay. So this will be the cash flows for initial year cash flows. Okay. Initial year cash flows. One more point here. Okay. Where we have few adjustments alone I will discuss in the end. Okay. We have some 2-3 adjustment. One is the depreciation adjustment. Then we have the tax adjustment. Then we have the working capital adjustment. All these 3 adjustment I will discuss once after I complete this cash flows thing. Okay. And here we also have working capital. Yeah, the initial, suppose working capital is there, then working capital. I'll tell you what is working capital. This discussion is pending. Okay. So this is initial cash flows. Second one will be annual cash flows. Okay. Annual cash flows. Annual cash flows is nothing but what is the annual cash flow? Suppose if an income statement is given, directly put the income statement and find out the annual cash flows. Annual cash flows now from year 1 to project, from year 1 to life of the project. Okay. From year 1 to life of the project. You just have to do year 1, 2, 3, 4, and 5. Okay. Suppose sales data is given, just write the sales data minus variable cost data you put, contribution you put. If fixed cost is given, do fixed cost. Then find out the earnings, then find out the earnings. Then reduce taxes. Okay. Everything you do, and then before taxes, if depreciation is there na, then also reduce depreciation also. Then if you will get earnings before taxes. Okay. Then you reduce taxes, then you will get profit after tax. Always add back depreciation. Okay. Always add back depreciation. Then you will get year cash flows, year 1 cash flows, year 2 cash flows, year 3 cash flows, year 4 cash flows, year 5 cash flows. This is how a typical problem looks like. So this is an annual cash flows. Always find out the annual cash flows. If profit after tax is given, directly add all the non-cash expenses. Okay. If working capital is there, put the working capital adjustment. If tax adjustment is there, put the tax adjustment. That I will discuss at the end. But this is the structure of the problem. This is the approach of the problem. Okay. First is the initial cash flows. Then you have to find out the annual cash flows. Then always put working note number 3, terminal cash flows. Okay. Terminal cash flows. Now under terminal cash flows, what will happen? In the end, okay, in the end, if you're selling the asset, then the salvage value of the asset or the scrap value of the asset, okay? Scrap value of the asset. Suppose if the life of the project is 1 to 5, so this is 1 to 5 years. So terminal cash flow, it is 6th year or no, it is 5th year only, okay, not 6th year, 5th year only. So salvage value or scrap value of the asset, this will be an inflow, okay? This will be an inflow, don't put negative. Salvage value, okay? And then whatever you have, we have put as working capital. This is very important. I'll tell you this adjustment. This working capital recovery will also be done. Okay. This working capital will be recovered. Okay. Working capital recovered. This working capital will also be recovered. There you have invested working capital, right? Under year 0, you invested working capital. So this working capital will be recovered in terminal. Okay. So working capital will be recovered. This is one adjustment. Salvage value, scrap value. If salvage value is there, then tax adjustment. Okay. Tax adjustment. Okay. Tax adjustment on scrap. So because of scrap, you will be having either tax benefit or you'll be having tax loss. So that's adjustment also you have to do. I'll tell you how to do the adjustment after this structure, but this is the structure. Whenever you're preparing a note, you should know what are all the things that will come and what are all the things that will not come and where this should come. Once you have an approach in the mind, any question comes, always make it in this approach, because this question is suitable for this approach is suitable for all the questions. Okay. Then the tax adjustments will be there. Okay. Tax adjustments. Then if there are any other cash flows, you just put any other cash flows. Suppose in the terminal cash flow also, there can be a possibility that there is a cost, because if you want to sell the asset, you have to remove that asset, correct? You have to remove the asset, and removal is having some cost. There is a possibility. Okay. Removal of asset is having some cost. So that will be a cash outflow. Okay. After all this, you will get the terminal cash flows. Okay. You will get the terminal cash flows. Now you have all the values here. Now the next and the final step is computation of NPV. Okay, computation of NPV. Okay, computation of NPV. And the computation of NPV, again put, okay, 0, 1, 2, 3, 4, 5. Okay, First will be the initial cash outlays. Okay, initial cash outlay. Directly put working note number 1. Here there will be some cash outlay. Say there is some amount here. Okay. Okay. Done. Then you will have annual cash flows. Annual cash flows. Directly put working note number 2. So if there are some annual cash flows, suppose the annual cash flows is this is 100, this is 300, this is 200, this is 50, this is 40. Okay, these are the annual cash outflows. And if there are any other adjustments, okay, any other adjustments that are balance sheet items, suppose if they have taken any loan, any other adjustments are there, it will also come here. But usually very rare problems are there. In one of the problem, they have took the loan and they have paid back in installments. These problems are there. Interest payments will be there. Okay, so all this, either you do it under the working note of annual cash flows or you do it under the working note of NPV. Then you put terminal cash flow. Terminal cash flow. Okay, working note number 3. Terminal cash flow will be in year 5. Suppose the terminal cash flow is say 100 rupees is a terminal cash flow. So now what you do? Okay, now what you do? You put the total cash flows. Okay, total cash flows. Year 0, what is the total cash flows? Okay, total cash flows. Year 1 it is 100. Year 1 it is 300. Okay, suppose say this is 400. Okay, this is 400, 100, 300, 200, 50, and 140. So these are the total cash flows. Now see, total cash flows you got. Now you have to multiply by present value. That was a vertical format. That was an horizontal format. This is just a vertical format, transpose of that. So now you got the cash flows. Now put present value factor. The discounting rate will be given. Suppose the discounting rate is 15%. This is 1. Put all the present value factors and then find the discounted cash flow. The total of all the discounted cash flow will be the NPV. If NPV is positive, accept. NPV is negative, reject. This is what a typical problem looks like. A typical problem of case study based problem looks like. Okay. Now let us study the adjustments. Once you know the adjustments and once you're comfortable in the adjustments, solve problems, practice problems, you'll be able to, sail through this capital budgeting chapter. Okay. First adjustment is depreciation. Depreciation. So depreciation is a non-cash expenditure. So depreciation is a non-cash expenditure, should not be considered. Okay, should not be considered in cash flows. Okay, but tax shield should be considered. What are you writing, sir? This I've already discussed. See, when you're having a PAT, okay, add back depreciation. Okay, add back depreciation. If you're starting from EBIT, then reduce the taxes and again add back the depreciation. Okay, this is one method. Or you directly add the tax shield or depreciation. Okay, this is what is the depreciation adjustment that you have to make. Okay, this is the first adjustment, depreciation. Second one, working capital adjustment. Okay, working capital adjustment. Now see, what is a working capital? What is a working capital? Working capital, you all know, current asset minus current liability. Any business you do, suppose if I'm taking a loan of 10 crore rupees, 10 crore rupees I'm investing in machinery, I will get profit or no. To get the profit, you should invest in working capital. One is a long-term investment. If you're purchasing a machinery, suppose the worth of the machinery is 1 crore rupees, you're taking the machinery, you purchased the machinery, kept in the factory. Just by seeing the machinery, you will generate profit or no. You have to use that machinery. To use that machinery, you have some cost. You have to pay salary. Just one moment. Okay. Sorry for that. So, yeah. Next one. If you're purchasing a machinery for 1 crore rupees, you'll not be able to generate profit. To generate profit, you have to use that machinery. To use that machinery, you have to have some inventory, some raw material, okay, some raw material, inventory, salaries you have to pay, all the working capital investment. So one is long-term investment, another one is working capital investment. Working capital investment, if nothing is given in the question, if in question, suppose it is given working capital requirement is 2 crore rupees, okay. So, or say 50 lakh rupees, okay, 50 lakh, because 2 crore is the cost of machine, 50 lakh rupees. So this 50 lakh rupees, when you are investing, sir, when you are investing 50 lakh rupees, when you will purchase inventory, always, if the question is silent, always you have to assume that in the 0th year, you're investing. So that is the reason 0th year I have put as working capital, okay, 0th year I have put as working capital investment, okay. One, machinery you will invest, second, working capital also you will invest. Okay, working capital also you will invest. Now see, why working capital again I'm putting in last year again. So there is one more concept. See, in the 0th year, first year, second year, third year, fourth year, fifth year. Just imagine 0th year I have put 50 lakh rupees as inventory. What will happen? This 50 lakh rupees I will sell, right? I will sell, some profit I will get, correct? That 50 lakh rupees I will sell, then again I have to purchase inventory of 50 lakh rupees, correct? So I will sell, suppose I will sell 50, I will sell for 50 lakh rupees, I will get cash, and then again I will invest, okay, and then again I will sell, again I will invest, again I will sell, again I will invest. But at the end of fifth year I will receive everything, I will receive the amount in cash, correct? I will receive the amount in cash, all this will be cancelled, but in the end of fifth year I will receive the amount in the cash. So always, whatever we are investing in working capital, we are assuming at the end of the life that amount we will receive, okay, that amount will receive, because this is a usage cost, this is a usage cost. Once the usage is stopped, working capital is a usage cost. Once the usage is stopped, at the end of the life, you will get the money. Okay, the money does not disappear in the thin air. Okay, you will get the money back. So once you get the money, you have to put it in the fifth year. So under fifth year, you should put as working capital recovery. This will not be given in the question. Once working capital amount is given, you have to reduce it in the 0th year and you have to add it in the fifth year. This is one adjustment that many students fail to do. Many students fail to do, but you have to be very careful. Whenever working capital is given, 0th year, if nothing is given, if they have given that 0th year, I'm investing 10 lakh rupees, first year I'm investing 20 lakh rupees, second year I'm investing 30 lakh rupees. Like this, if you have given, you put, okay, this 50 lakh, if they have given the bifurcation, 0th year I put 10 lakh, first year I put 20 lakh, then I put 30 lakh. Like this, if they've given, then you put like this. And then end of the fifth year, you directly put 50 lakhs as an inflow. But if nothing is given, if the question is silent, now always assume that working capital is invested in the 0th year. Okay, working capital is invested in the 0th year. Now, in one such question, what is happening is that they gave that my working capital, they gave the working capital levels. Okay, they gave the working capital levels. So in that case, what you have to do, you have to find out the working capital for every year. So 0th year, 1 year, 2 year, 3 year, 4 year. What they gave is that what is the net working capital. So net working capital, this amount alone they gave. So usually what we are assuming here as zero, correct? We are investing completely, but here that I need the net working capital. Okay, so now you have invested, suppose 100 rupees. Okay, so this 100 rupees you will recover, this 100 rupees you will recover. Then using this, you have to see what is your working capital requirement. So this 100 rupees you have invested, this 100 rupees you receive. But here, suppose they are telling that I want say 20 rupees. Yeah, I want say 20 rupees as the, because my closing balance of working capital is 20, 30, 40. Okay, suppose they're given like this. Then what you have to do, 0th year is 100, and fourth year, what we were assuming, fifth year I will again get 100. But here it is not happening like this. First year you're investing 100 rupees, but you want 20 rupees here. So second year I'm again investing 80 rupees. Okay, second year I'm again investing 80 rupees. Then I will receive this 80 rupees. I will receive this 80 rupees as cash. Then again I'm investing 50 rupees. Okay, and then I will receive this 50 rupees as cash. This is 50, then I'm investing nothing because this is 50. Okay, then I'm investing nothing. So how much is my total investment? 100 plus 80 plus 50. There is one such question like that. So that is the reason I'm discussing in this way. So this is one working capital adjustment that you have to make. Usually nothing is given in, usually nothing will be given in the question. 0th year reduce, fifth year increase. Okay, or if something is given, you just have to put it in this way. So working capital adjustment done. Third one, very important one, tax adjustments. Okay, tax adjustment. Now see, tax adjustment, the tax adjustment on depreciation we already discussed, correct? Depreciation already discussed. Wherever tax impact will be there, depreciation it will be there, because depreciation is affecting the cash flow, and depreciation tax impact will be there. What is the second one? Okay, second one, suppose scrap value is there. Okay, suppose scrap value is there. Now you have purchased the machinery. Okay, you have purchased the machinery. What cost we don't know. Suppose the book value of the asset is, okay, book value is not considered, but suppose the book value of the asset is 50 lakh. Okay, and you have sold the asset for 60 lakh rupees. You have sold the asset for 60 lakh rupees. What you will do whenever you are selling, suppose on the terminal cash flow, fifth year you are selling, fifth year what you will do as an inflow, what you will put, okay, sale of machinery, sale of machinery. What you will put, 60 lakh amount you will put as inflow. But what is happening, because of your book value, whenever book value is given, tax impact will come. Okay, or tax rate is given, tax impact. In many questions they will tell ignore taxes on scrap value, but in few questions if it is silent, you have to put the tax adjustment. Now what is happening, if their book value is 50 lakh rupees, okay, if your book value is 50 lakh rupees, okay, and your salvage value, if your book value is 50 lakh rupees and your salvage value is 60 lakh rupees, are you getting a capital gain or capital loss? What you're getting a capital gain. What is your capital gain? 10 lakh. What is your rate? Suppose your rate of tax is 30 percentage. Okay, that means you have to pay 3 lakh as taxes, correct? So 60 lakh rupees you receive as inflow, but you will pay 3 lakh to government, correct? Then you have to put tax expense on, okay, tax expense on scrap. Then 3 lakh you have to pay to government, and then your net terminal cash outflow is not 60, it will be 57 lakh. So this is one tax adjustment. Okay, this is one tax adjustment that you have to make. See, there are only three cases possible. There are only three cases possible. Your book value is less than salvage value. Your book value is equal to salvage value. Your book value is more than salvage value. See, if the salvage value is more and the book value is less, you will get capital gain. And once you get capital gain, you will get tax expense. Okay, you will get tax expense. So tax expense will be a cash outflow. If your book value is equal to capital, if you equal to salvage value, then nothing will be there. Okay, nothing will be there. Directly, your inflow is equal to salvage value. Your inflow is equal to salvage value. If book value is more than salvage value, which means you will have a capital loss. So if you have a capital loss, this loss you can again set off to with any other expense, correct? So you will have a tax benefit. Okay, you will have a tax benefit. So this will be an inflow. Okay, this will be an inflow. So to find out the terminal cash outflow, okay, to find out the terminal cash outflow, so cash flow is equal to salvage value minus tax expenses, if book value is less than salvage value, plus tax benefit if book value is more than salvage value. Okay, if it is equal, na, directly salvage value is equal to cash value. If it is not equal, na, tax adjustment, plus or minus tax adjustment you have to put based on the book value. How to find out the book value? Book value, you know, right? Cost minus depreciation. Okay, cost minus depreciation. If it is WDV, na WDV. If it is SLM, na SLM. So what is the book value? If book value is directly given in the question, directly take it. If it is not given, prepare a depreciation schedule. What is the WDV? Okay, book value is equal to WDV. WDV, what is WDV? Cost minus depreciation is the WDV. Okay, so this is one adjustment. Now final one, advanced one. Okay, final. See, slow by slow, you know, I am increasing the difficulty, because even in exam also problems, first easy problems were asked. Now slow by slow exams were also increasing the difficulty by putting many adjustments into the problem. So whatever all the possible adjustments we are trying to discuss, because you know, once we discuss all the crisp points, you will have a proper understanding of the chapter. So any problem comes, you will be able to have a confidence that yes, I know this. Okay, yes, I know this. You should be comfortable with the problem is what our objective is. Okay, so now the next one, is the incremental cash flows. Okay, incremental cash flows. We will also discuss the opportunity cost and benefit also here. This is also one more adjustment. Opportunity cost or benefit. I'll tell you one thing. Okay, I'll tell you one adjustment. Whenever you're having anything called as sunk cost, Okay, what is sunk cost? Cost that has been incurred. Okay, cost that has been incurred, which is having no relevance now. Okay, now for example, whether I want to take this project or not, I did some consultation and then I paid some consultancy fees. Okay, I did some consultation, I paid some consultancy fees. Year zero, you will reduce. No, see, because this has been incurred. Sunk cost, incurred cost. Okay, incurred cost. Year zero, what is the cost that you're going to make which will affect the decision is only. Now, if you accept the project or reject the project, sunk cost is already gone, correct? If you're rejecting the project, is sunk cost, he will refund, he will not refund, correct? So sunk cost, you should not consider in cash flows. Why sunk cost should not be considered in cash flows? 1 minute. Okay. Now, listen to me. Sunk cost. What is a sunk cost? The cost which have been incurred and it is irrelevant for taking a decision. Cost which have been incurred, irrelevant for taking decision. Okay, irrelevant for taking decision. See, if I'm putting the cost of machinery as 1 crore rupees, if I'm accepting the project, I will purchase the machinery. If I'm rejecting the project, I will not purchase the machinery. So purchasing the machinery, that cost becomes relevant. Sunk cost, if I'm accepting the project, I will not pay sunk cost. If I'm rejecting the if I'm accepting the project, I'll pay sunk cost. If I'm rejecting the project, I will not pay sunk cost. It is not like that. Either you're accepting or rejecting. If there is any cost incurred which is irrelevant to the decision, is what is called as sunk cost. Okay, is what is called as sunk cost or irrelevant cost. Sunk cost is one such cost. Irrelevant cost also you should not consider. Okay, so you should not consider it in the cash flows itself. If in the question it is given that for taking a project they met some consultant and that for that consultancy they're paying some 1 lakh rupees. Okay, don't put this 1 lakh rupees in year zero. Okay, because you will think, okay, year zero, there is one cash up to 1 lakh rupees. Don't put this cash flow. This cash flow we should not consider while taking decisions. Okay, this will not come into the NPV calculations. This is one. Second one. Second one is opportunity cost of benefit. That also you have to consider. Okay, now for example, if it is given in the question, I am having a land. Okay, if it is given in the question, I am having a land. Okay, had I given the land to rent, I would have earned a rent of say 5 lakh rupees per annum. Okay, I would have earned a rent of 5 lakh rupees per annum. Okay, had I given the land to rent, but I am now using that land for this project. I'm using this land for this project. Now, what you all will be thinking, there is no cash flow involved because it is my land. I'm not paying to anyone. No cash flows involved. So why to, okay, see, now this becomes a relevant decision, correct? See, had I, because this is an opportunity, the opportunity cost, correct? Had I given the land to rent, I would have got that 5 lakh rupees per annum rent to me. But since I'm taking this project, this 5 lakh rupees rent time foregoing, correct? This 5 lakh rupees rent time foregoing. So that foregoing of some benefit is a cost to you, correct? Or you can even think this way: if I want to take that place at rent, I would have paid a rent of 5 lakh rupees. Because it is my land, I'm not paying, but still I should consider this for taking decision. Why? Because it is a relevant decision. Okay, so opportunity cost or benefit. Opportunity cost or benefit, this also you have to consider. Now you have to identify. Okay, these things, this is one example I've given. 100 examples are there. Okay, but you have to identify. Okay, whether there is any opportunity cost or benefit that you're having. Okay, this is one thing. Even for this relevant cost, I will give you one more example. We were having some idle labors. We are using that idle labors. Okay. We were paying salary of 1 lakh rupees to that idle labors. Now we are using that idle labors in this. Now, is there any cash flow involved? No. See, we will pay this 1 lakh rupees salary. We will pay this 1 lakh rupees salary. If he's working on the project or not working on the project, we will pay this 1 lakh rupees salary because he's an idle worker. So this 1 lakh rupees, you don't put it in annual cash flows. Okay. I have to pay salary of 1 lakh rupees because these are idle labors. Even if they're working or not working, I have to pay them 1 lakh rupees. So that becomes an irrelevant cost. Okay. So that should not be considered in the cash flows. These are small points, that will test you. Capital budgeting is one such thing where one mistake, entire problem goes for a toss. Okay. So here adjustments have very big value. But if I say, if it's not working, I have to pay 1 lakh rupees. But if I'm making him work here, I have to pay a salary of 1,20,000 rupees. I have to pay a salary of 120,000 rupees. Now, what is your relevant cost? What is your relevant cost? Because 1 lakh was irrelevant. 1 lakh anyhow you have to pay. Now, because you're making him work into the project, you have to paying him salary of 1,20,000 rupees. So now you don't have to take cash flow of 1,20,000 rupees. You have to take the incremental cash flow of 20,000 rupees. Okay, you have to take the incremental cash flow of 20,000 rupees. This is one more example of relevant cost. Okay, incremental cash means relevant cash. Okay, relevant cash. The relevant incremental cash alone you have to take. Okay, incremental cash flows alone you have to take into the consideration of capital budgeting. Okay, anyone who is having any doubt, please put it in the chat box. I will take up. Or am I going any very slow or fast? Okay, I think I'm going slow only. But even if you're facing any difficulty, please put it in the chat box. Are you all able to following me or not? I'll just wait for 1 minute. Since it's a live class, let us take the benefit, right? Okay, pa. Okay. So now we have discussed incremental cash flows, relevant cash flows, sunk cost, opportunity cost, and benefit. All these are small adjustments. Okay. All these are small adjustments that will eat away 2 or 3 marks. Okay. Just imagine a 6 mark or 8 mark problem eating away 2 or 3 marks just because of this small thing is not a good thing. Okay. Next is allocated overheads. These are all the same branches. Allocated overheads is again an irrelevant. Okay, allocated overheads. See, in costing you would have studied. I am having some head office rent. That head office rent I am allocating it to different projects. Okay, so if this project, if I'm allocating it to 5 lakh rupees, this 5 lakh rupees becomes irrelevant. Okay, because I'm accepting this project or not, definitely they have to pay the rent. Okay, just because I'm not accepting, they are not able to. They will not pay proportionate rent to them. Okay, so any overheads which is allocated to this project, allocated overheads are irrelevant. Any expense that I'm making because of this project, I have to take. Any expenses that have been already allocated. If any word is given, allocated overhead of 5 lakh rupees, okay, or overhead has been allocated 5 lakh rupees in year 2, or overheads are allocated every year 3 lakh rupees, don't consider 3 lakh rupees, okay? It is an irrelevant cash flow. Okay, so all this we are completed. Now one more advanced level discussion, okay, little advanced level discussion. If we are having a decision of replacement, see, if it is a fresh decision, it is very easy. Okay, now please follow. If it is a fresh decision, it becomes very easy. 0th year, cost of the new project, installation cost. First year, what is the benefit that I'm getting because of the machinery? Some benefit I will get, some cash flows I will get because of the machinery. Either it will be sales, or it will be directly cash flows will be given, or you have to make the income statement. Benefit will be given. If that machinery is there, depreciation will be there. That depreciation, okay, that depreciation you have to reduce, take the tax impact, add back the depreciation, and then you have to calculate the cash flows. That will be the annual cash flows. Then at the end of the project, if you're selling that machinery, then salvage value becomes the terminal cash inflow. Then you have to check what is the WDV of the machinery and what is the salvage value of the machinery. If it is positive or negative, based on that positive or negative, you have to take the tax impact, and that tax impact you have to take. So that becomes very easy. Now suppose there are one more type of problem, which is a replacement problem. Now what is happening? You already are having a machinery. The life of the machinery is 10 years. Okay, the life of the machine is 10 years. Fifth year, what you are telling is, no, I don't want this machinery. I want some advanced machinery. Okay, suppose you purchased a machinery. Okay, suppose you purchased a machinery. From 1 to 5 years you are using it. Okay, now fifth year you are trying to replace. Okay, fifth year you are trying to replace, and that were having a life of 10 years. Okay, that was having a life of 10 years. 6 to 10 years, what you're telling, no, I don't want this machinery now. I am purchasing another machinery which is having another life of 5 years, say, just for an example. Okay, so here I was generating a cash flow of, say, 5 lakh rupees per annum. Okay, 5 lakh rupees per annum I was generating the cash flow. I'm making it pretty simple. But now I want to make an advance. Now demand is more. Now I want to make an advanced machinery. So for this advanced machinery, I have to sell this machine. Okay, I have to sell this machine. Suppose I purchase this machine in 1 crore. Now after 5 years, if I'm selling this machinery, I'm getting only 20 lakh rupees. And I'm purchasing this machinery. This machinery is advanced machinery. I have to pay 1.5 crore rupees. And because I'm purchasing this advanced machinery, my revenue will become 10 lakh rupees per annum. Okay, my revenue will become 10 lakh rupees per annum. Just imagine, just visualize a situation like this. Okay, just visualize a situation like this. Now what will be your initial cash inflow? Your initial cash inflow will be, first, cost of new asset. That will definitely will be there. Okay, 1.5 crore rupees. Okay, 1.5 crore rupees. This will be there. Okay, 1.5 crore rupees. This will be there. Then you will have an inflow also, right? Here scrap will be there. Here, correct? So scrap value of the old machinery. Okay, scrap value of old machinery. What is the scrap value? It will be in positive. Okay, what is the scrap value? It is 20 lakhs. So 20 lakhs is the scrap value of the machinery. Just 1 minute. Okay. So cost of new machine and scrap value of old machinery. Okay, now when you're selling this old machinery, scrap value, there can be a tax impact, correct? So plus or minus tax impact on scrap, correct? Now here in initial only it will come. Okay, tax impact on scrap, there can be a tax impact, correct? There can be a capital gain, or there can be a capital loss, and there can be a tax impact. So that will be some amount, and that will become your initial cash flows. Okay, that will become your initial cash flows. Done. Okay, now here under annual cash flows. Okay, under annual cash flows, see, usually you are having two impact. One is the total approach, one is the incremental approach. It is better to follow incremental approach because it is logically correct. So now you were having a cash flow of 5 lakh rupees. Okay, now you are having a, so here also all these are incremental, correct? This tax impact is also incremental, cost is incremental, this scrap value is incremental. When you're taking the decision, definitely this cost you have to sell, definitely you have to purchase the new machinery, definitely old value you have to sell, and definitely tax impact will come. Okay, now the next one is incremental annual cash flows. Okay, now when you're having a, so here also all these are incremental, correct? This tax impact is also incremental, cost is incremental, this scrap value is incremental. When you're taking the decision, definitely this cost you have to sell, definitely you have to purchase the new machinery, definitely old value you have to sell, and definitely tax impact will come. Okay, now the next one is incremental annual cash flows. Now from 1 to 5 years, the next 1 to 5 years, because you're purchasing this machinery, you are getting an extra income of 5 lakh rupees, correct? You are getting an extra income of 5 lakh rupees. So what you do, just an incremental approach, 5 lakh rupees, you put 1, 2, 3, 4, 5. And by that, you calculate all the incremental cash allowance, you calculate it. Now, for example, if you are having every year you are having a running cost of 50 lakh, 10 lakh rupees, you are having a running cost of 10 lakh rupees, but this machinery is having a running cost of 12 lakh rupees, then this 5 lakh rupees is the incremental revenue. Then put the incremental or running cost. What is the extra cost that you're paying because you're purchasing the machinery? The extra cost that you're paying is 2 lakh rupees every year, that you're paying the extra cost. What is the extra revenue that you're getting because you're purchasing the machinery? 5 lakh rupees is the extra revenue that you're getting. Okay, so your net cash flow is 3 lakh rupees. Just an example. Okay, your net cash flow is 3 lakh rupees, and then in this 3 lakh rupees you calculate the NPV. Total approach. Now what you're doing, you're putting the total 10 lakh rupees, and then you're putting the total running cost, and then you're calculating. Anyhow your answer will be same, but incremental is more logical, but more you can solve it in any way. Are you all understanding? Okay, little bit advanced, but still I am trying to making it as simple as possible. Okay, now here one more impact can be coming, one more impact they can give. What is the impact? In one problem it is there. Okay, only one problem I saw, one problem is there. What is happening that this machinery they were doing WTV. Okay, now this machinery they are trying to do SLM method. Now what is happening? Because there is a change, in valuation of depreciation, because there is a change in method of depreciation, there can be an incremental tax benefit or tax expense also. Are you all able to understand? See what is happening. What is happening when you're doing an incremental approach? This can be pretty complicated. You may feel pretty complicated. See, total approach, what you will do, directly you will put the total revenue, directly you will put the total running cost, and then directly you will put the total depreciation, and then you will get the answer. Okay, total approach is easy to do, but logical is incremental approach. I'll tell both the approaches, so you follow whatever you want. Incremental approach, you take the incremental benefit. Okay, reduce the incremental cost. What is the incremental benefit? 5 lakh was the income, 10 lakh is the income, so 5 lakh is the extra income. 10 lakh was the running cost, 12 lakh is the running cost, so 2 lakh is the extra cost. Okay, so this is the incremental cash flow, 3 lakh rupees. Now what was the depreciation? Okay, so WDV method, if I want to follow depreciation, if I want to follow WDV, what was the depreciation? Say 1, 2, 3, 4, 5. So if I were to follow, my depreciation would have been, okay, 10, because depreciation will reduce 9, 8, 7, 6 if it was WDV. But now since I am taking in SLM method, now my depreciation now will be say 20, 20, 20, 20, 20. So what is my extra depreciation that I'm making? Here 10 lakh is the extra depreciation I'm making. Here 11 lakh is the extra depreciation I'm making. Here 12 lakh is the extra depreciation I'm making. 13 lakh is the extra depreciation. Okay, and 14 lakhs is the extra depreciation I'm making. So all this extra depreciation you have to add back. Okay, all this extra depreciation, so incremental depreciation you have to add back, and on this extra depreciation, what is the tax benefit that you will get? That benefit also you have to add. Okay, that benefit also you have to take it. Okay, now what is the tax on such extra depreciation? What is the tax on such extra depreciation that you have to take up? And with this you have to find out. There is one problem. Okay, I don't remember where that problem is, but if there is one problem like that, so if you solve that problem, all these points will be revised. Okay, this problem alone before going into examination you see. Okay, this problem alone before going into examination you see, or in the Sundays class I'm taking, right? In that Sundays class I will take this problem. Sundays class I'm not taking to SICASA, I'm taking other. If you want, you can DM me, I will send you the details. It is a free class. You can, if you're in Chennai, you can come face to face, or I will send you the Google link. You can join it from there and you can see that class. So there is one class Saturday and Sunday I'm taking. I mean, tomorrow and day after tomorrow. Saturday will be the concept class, whatever we are discussing, right? If you are seeing this class, no need to attend the Saturday's class. Sundays I'll be doing the problems. One problem is included there. I will be doing the important and comprehensive problems. So that will be a problem revision for that. So Sunday you can attend this class if you want a problem revision also. Okay, so this was the concept. So you can DM me. So my number is 9025673914. Other than that, if you have any other doubt, okay, any other doubt, please reach out to me if your preparations are not going well, or if you're having some doubt in financial management, or if you require some support from me, whatever is possible from my side, definitely I will do it. Okay. Or you can even message me and tell that, sir, I attended today's class and these are the things that I felt. These are the things that I felt after this class. I felt little comfortable in this topic, or I felt little uncomfortable in this topic, or this looks difficult, or this looks confusing. Some review or some feedback you took, or this, if you'd have taken in that way, that would be better. I appreciate feedbacks and I also appreciate criticisms. Okay. So no doubt, even if you're telling that this chapter you didn't took properly, I'll be definitely happy to do that. I will be happy to take note of that, because only if it is a two-way relationship. I believe in two-way relationships. A relationship, teacher should also put efforts and students should also put effort on the teachers. Okay. So once we do this, we will, come in a proper situation where we both are on the advantages situations. Okay. So with this, I think, let me see if I missed anything in capital budgeting. Yeah. One more concept is there. If you are having two projects, okay, if you're having two projects, I already told you decision rule. You have to find NPV, higher the better. Okay. Higher the better. If you're having IRR, that is also higher the better. If you're having payback, that is lower the better. Okay. Now this will work only if the lives are equal. If two projects where both the projects have 5 years life and 5 years life. But suppose if you're having unequal lives, okay, very important, unequal life. You are having two machinery. For one machine, the life of the machinery is 6 years, another life of the machinery is 4 years. Okay, here 6 years cash flow will be given. Okay, here 6 year cash flow will be given, and here 4 year cash flow will be given. So in that case, how you will find out, because this NPV and this NPV is not comparable, correct? This is the 4 year NPV, this is the 6 year NPV. So what you have to do, you have to find something called as annualized NPV, and then you have to take a decision. Okay, you have to find annualized NPV and then you have to take a decision. What is annualized NPV? That is nothing but NPV divided by annuity factor. Okay, NPV divided by annuity factor. You can directly tell, sir, average you can do, right? 6. So if this is the NPV, you do divide by 6 annual NPV. You do divided by 4 annual NPV. See, if I do divide by 6 and divide by 4, I'm forgetting the time value of money factor. Okay, if you're having time value of money factor, if I cannot add year 1, 2 and year 2 cash flows, then how can I divide year 1 and year 2 cash flows? Correct. So if I want to divide the cash flows, I have to divide the annuity factor. If I want to add, I have to use the present value factor. Okay. So if I want to divide the factor, you put the annuity factor. So what you have to do, this NPV divided by annuity factor for 6 years. Okay. And this NPV divided by annuity factor for 4 years. If you do this, you will get annualized NPV, and through this annualized NPV, whichever is higher, you have to take a decision. I'll just show one problem of unequal life. Yeah. Now see this problem. See this illustration. Two projects are there. If you see here, it is only 1 year. Okay, the life is only 1 year. If you see here, the life is 3 years. Okay, if you see the life is 3 years, the cost of capital is 20%. Now, which one should be accepted as per NPV and as per IRR? Now, NPV, if you want to calculate, you cannot calculate NPV directly. So first, what you do, you calculate the NPV for both the cash flows. So this will be the NPV and this will be the NPV. But you cannot, I think you have to take annualized NPV. This is not correct. 1 minute. This is not the concept. 1 minute. This is just to explain if we are having unequal life, then how we have to do. So this is just an illustration. This is just an illustration. What we have to do is that we have to annualize this cash flow and then we have to take a decision. Because here there will be a disparity between NPV and IRR. If you see here, NPV will show this is good, but IRR will show this is good because of contradiction in ranking. So this you have to do by unequal lives. 1 minute. There is one problem in exercise. Once we see that problem, that will be good. See question number 6. Okay, see question number 6. ABC is planning to invest 2 machineries. Okay, the purchase cost and life is given. Okay, life is given and running cost per year is given. So this is 0th year investment. Running cost per year. So 1, 2, 3. Running cost per year is 4 lakh and 1 and 2 running cost is 6 lakh rupees. So first find out the NPV. What is the NPV? 0th year 15 lakhs. Okay, 1 to 3 years 4 lakh. So 15 lakh and the running cost is 4 lakh. Okay, this is also an outflow. Then you have to calculate the NPV. Okay, purchase cost and then running cost, and then you have to calculate the NPV of this, and then again you have to calculate the NPV for this 0 and 1 to 2 years. Once you find out the NPV, you divide this with present value annuity factor for 1 to 3 years, and here you divide this by present value annuity factor for 1 to 2 years. You will get annualized NPV. Okay, you have to write this annualized NPV. Now with this annualized NPV, whichever is more, you have to sorry, here it is cost. Okay, so whichever is less. See, again one more error we can make. See, here we are not evaluating profits, we are evaluating cost. So cost now, whichever is lower. Okay, suppose if my NPV for machine A is 1 lakh rupees, so it is negative, correct? And my machine B is, because it is an outflow, it is 1,50,000 rupees. Now you will say, sir, negative, sir, more is B. So I machine Y, so I will take machine Y. No, machine A, machine X and Y. So machine Y is having NPV of negative 1,50,000. Machine X is having an NPV of negative 1 lakh. Then which machine you should choose? The machine which is having less cash, which is having less cost, which is having less outflow. So machine X you have to choose. That is the reason that is the reason for outflow you put sign, so you won't be get confused. So even if I see higher is 1 lakh only. Okay, higher is not 1,50,000, higher is 1 lakh only. Sign changes. So that is the reason I always used to say outflow na put negative and inflow na put positive. So if you see the 6th one here, you see how 6th one is solved. You put purchase cost machine, this is the problem, present value annuity factor, then present value of the running cost of the machinery, and cash outflow. If you add both the cash outflows, okay, if you add everything, you will get the 15 is 0th year, correct? So 15 lakhs plus 4 lakh into present value annuity factor, which will come to 10 lakh 12,400. This will become 10 lakh 55,400. Okay, this is the present value of the running cost. If you add 15 lakh plus 10,000, it will become 25 and 20 lakhs. It is nothing but 0th year one outflow is there, running cost is again one outflow. So the total cash outflow is 25 lakh 12 and 20 lakh 55. This is the NPV, or you can also say cash outflow of the machinery, present value of the cash outflow of machineries. Okay, and then you have to put equivalent present value of annual cash flow. You can also put annualized NPV. Okay, annualized NPV. So what is annualized NPV? This amount divided by present value annuity factor, 9,92, 11,92. So machine X is better here. Okay, machine X is better here. Okay. So unequal life concept is also done. Is there anything else that I'm missing? Actually, I should not take all the concepts, but since I thought it is a very important chapter, let me go it very slow. See, if you can see, 10 o'clock we started, 1 o'clock, 3 hours, only one chapter only we did, capital budgeting. But don't worry, Next chapters and all, it won't take time. Even last time it happened the same way. Cost of capital, yesterday I took only cost of capital took time. Cost of capital took around 2.5 hours time. All other chapters we completed, in flow. The same thing will happen today also. Capital budgeting will take time because it is a good, it is a good chapter. Lot of discussions can be made, lot of inputs I can give, and lot of advantage you can take it from this class. All other chapters can be will be very simple formula based chapter, so I will go little speed, so don't worry about the speed. So investment decision is completed. Unequal life is completed. Is there anything else? Yeah, one more, and this is the last concept. It is capital rationing. Rarely it is asked, but this is also very interesting. Okay, capital rationing. Now what will happen? They will give you different projects. They will give you, see, project A, project B, they will give you. Okay, project A, project B, you have to choose any one project. But here what they will tell you, I have 100 crores. Okay, and I have project A, project B, project C, project D, project E. Okay, for this investment is 50 crore, for this investment is 20 crore, for this investment is 10 crore, for this investment is 5 crore, for this investment is say 25 crore. Usually what we used to do, if we are having any project, now first we'll find the IRR. Wherever higher IRR is there, you will find out. Or you will find out the NPV. Wherever NPV is more, you will invest. That is correct only. That is correct only. But here what they are telling, but that will apply only if the projects are mutually exclusive. Mutually exclusive, now either accept or reject. But here what we can do, we can choose multiple projects, correct? I am having 100 crore rupees. I can invest in A, I can invest in B, I can even invest in C. I will have 80 lakhs. Okay. And then I can even invest in D. Okay. So all these combinations are possible. Or I can invest in E, I can invest in D, okay, 80 lakhs. And then I can invest in A, B, and also DE. All these combinations are possible. That is what is called as capital rationing. Now, in capital rationing, what you have to do, you have to give ranking, okay? Because only then which one to choose first, okay? You cannot do by calculating. You have to put calculation, okay? So what you have to do, first you find out the NPV. First, you find out the NPV. Suppose you found out the NPV. Okay, here the NPV is 5 crore. Here the NPV is 1 crore. Here the NPV is 2 crore. Here the NPV is here the NPV is only 10 lakh rupees, and here the NPV is say 15 crore rupees. Now, if you see, say 15 crore rupees is the NPV, let us choose first. No, see, by investing 25 crore rupees, you are getting 10 lakh is very low. See, by investing 5 crore rupees, you are getting 10 lakh rupees. Okay, by investing 5 crore rupees, you are getting 50 lakhs. So it is only 10%. By investing 5 crore, you are getting 10. So it is only 5%. So by NPV alone, you cannot calculate. So what you have to do, either you have to put NPV percentage or you have to put NPV per rupee. Okay, both things are possible. In textbook, NPV per rupee is there, or NPV percentage also you can put. Okay, NPV percentage, wherever percentage is higher, you choose ranking one, because now you have to rank. So what you have to do, NPV per rupee, NPV per rupee of investment. Okay, NPV per rupee of investment. So what you will do, you will divide this 5 crore of NPV to 50 crore rupees. Okay, which means, okay, 5 crore divided by 50. What does it mean? For every 1 rupee of investment, I am getting 0.1 rupee of NPV. This is what it means. Okay, suppose now you are bringing it all into the same table. Okay, here, because different investment amounts are there, different NPV will be there. Now you are breaking everything into the same table. So now this will be 0.02, this will be 0.05, this will be 0.2, this will be 0.3, for example. Now, if this is the case, now you have to give ranking. Okay, now you have to give ranking. So this will be one first rank, this will be, sorry, this will be first rank, this will be second rank, okay, this will be third rank, this will be fourth rank, and this will be fifth rank. Okay, just based on some ranking we are doing. Now, if we are doing some ranking, now this we should select first. Now we'll have selection of projects. I'm just giving you the step how to solve a problem. You see the study material, how these are done. Okay. Now selection of projects. So first project, you took 25 crore rupees. Okay. Then you do cumulative till 100 crores you can put. Till 100 crores, wherever it is stopping, you just stop it. Okay. You just stop it. Likewise, you have to solve a problem. Now here, two things are possible. If the question is giving project is divisible and project are indivisible. Now what is this part? Divisible and indivisible. Okay, projects are divisible and projects are indivisible. See, projects are divisible now. Projects can be breaked. Let us see project are indivisible first. If project are indivisible now, A, B, C, D. Suppose if A, B, C, D is selected, and even if you're having some remaining amount of 10 crore rupees, you cannot invest in E, you cannot invest in E, so you leave that amount, okay? So you will leave that amount, which means project are indivisible. So you just have to put A, B, C, D, okay? E you cannot take, even though you're having some 10 crore rupees, E you cannot take because project are indivisible. Project are divisible, now you can take part project. Okay, indivisible example is building, okay? You cannot tell I will only put half building, I will only construct half building because I'm having only that much money. Either you construct full building or you don't construct a building, okay? Project are divisible, now there is some order, okay? I'm having 25 crore rupees order, I can say I'm having only 10 crore rupees of investment, so I will supply only 10 crore worth of this. So you can take proportionate. So what you can do here, you will take A, B, C, D, and E alone you take 50 percentage. Okay, E alone you will take 50 percentage, such that your 100 crore is utilized. Here also you are utilizing 100 crores, but you will have some remaining amount of say 20 crore rupees. Okay, but here you will utilize the entire 100 crore rupees. This is how a capital rationing problem works. Okay, this is how a capital rationing problem works. Let me show you one problem, because once we link it with the study material only, then you will feel comfortable that okay, we are studying something which is relevant. Okay, I know you trust me that I'm teaching only relevant things, but there should always be backing for this trust. Capitalization. Yeah. See this project. See this question, capital rationing. Shiva is planning his capital investment for next year. It has 5 projects, okay? And all are giving a positive NPV, okay? Directly NPV is given. Directly NPV is given. The company is having 1,20,000 rupees. Now 1,20,000 rupees they are having, okay? Now 15% NPV, these are the cost. So what you have to do now here, you have to illustrate within the projects are independent of each other and are divisible. Okay, they are divisible. Divisible, na part project is possible. So first step, find out the ranking. How you'll find out the ranking? The table, project, investment, NPV, then NPV per rupee. Okay, NPV per rupee of investment. Or you can even put NPV percentage, but let's, in the exam, it is putting NPV per rupee invested. Okay, NPV, it is nothing percentage, it will be 31%, 47%, NPV per rupee invested, logical way. Now, based on that, you will give a ranking. So E is giving a first ranking, B is given a second ranking, okay, 35, 40. So how much C is giving? C is giving then C is giving 20. Then D amount is 30, but how much is the amount that you're having? 35, then 40, 75, then 100. But you are having only 120 rupees. You directly put the total as 120 rupees. You directly put the total as 120 rupees. D, even though the investment is 30 rupees, you cannot put, you cannot put total 30 rupees. You only have 20 rupees in your hand. So you're investing only 20 rupees. So now your NPV will be 19.3, okay, 18.7, 10.1. And here, because how much you're taking only 2/3 of the project, okay? Out of 30, you're taking only 20, okay? So 20 divided by 30, only 0.67% you're taking, okay? 66.67% alone you're taking, okay? 2/3, so 66.67% of the project you're taking. So NPV will also be proportionate. Here NPV is 11.2, so 11.2 into 66.67% if you do, you will get 7.5, okay? 7.47 or 7.5 you will get. So even if you have to do this proportionate, this is one step people forget, then you will get the actual NPV, okay? You will get the actual NPV based on the ranking. Thus, project A should be rejected and only 2/3 of project D should be undertaken. So this is framing the answer. Just by writing is not enough. Okay, which is rejected? A is rejected and D. Now, if the projects are not divisible, then what are the other combinations? Okay, if the projects are not divisible, then only 3 projects you can take. So I think there is also a second question there. You are required to illustrate within the capital, the projects are independent and divisible. Okay. So one more. This is just another way, not given in the question, but suppose if there is a question, if the project are divisible, what you should do? Then I already said you cannot do part projects. So E plus B plus C you will take. Okay, E plus B plus C you will take. And another combination is E plus C plus D, because A definitely you will reject. You're not having money. So either you will take B or you will take C, and then you will see where the NPV is higher. E plus B plus D, the NPV is higher, just take this. So this is capital rationing problem. See, this chapter alone is required, some amount of thinking. All other chapters formula based. Once you know the formula, you'll be able to do. But this chapter alone is required some thinking. In techniques of capital budgeting, no thinking is required. But still, to estimate the cash flows, thinking is required. Okay, because word problems, case study problems are there. So this becomes very important, and that is the reason I took little bit more time and I solved some problems and also linked it with the study materials. Okay, so please let me know if you have any doubts. So please chat in the YouTube, and we'll end the class now. We'll meet in the 2 o'clock class. Fine. So thank you very much.
1 second. Can we get some queries if we have?
Yeah, sure. Do we have any queries? Yeah,
Yeah,
sure.
1 minute, 1 minute. I'll just get back to YouTube.
Sure. We'll meet in the 2 o'clock class. Meet in the 2 o'clock
Yeah.
class.
As of now, we have a comments like "Hello, sir. No doubt, sir. Clear, sir."
Sure.
Which were
See, if
given.
you have any doubts, I'll take it up. No problem. I usually take it up the doubts. Okay.
Yeah, sure.
Sure.
I don't see
Okay.
any doubts over here at least as of now. So thank you so much, Thofik sir.
Sure.
We shall get back at 2 o'clock.
Sure.
Thank you.
Thank you very much. Okay.
Uh,